welcome to weekly session of Chartsarefun. This is for the week of April 27th, recording this on the morning of May 3rd. This is Avijit Chatterjee. The service that we have in Chartsarefun, there is a site on Substack. That's our blog site. Appreciate you subscribing to it. And when the blogs come out, they'll be sent to your email. And our YouTube site is also Chartsarefun. We do believe that there are tremendous insights in these charts. We think there are a lot of fun insights on these charts. We don't provide investment advice. Our goal really is to share these fun chart patterns and then hopefully help them guide in your investment decisions. The key theme this week that we're going to talk about is there has been a lot of comparisons to what happened in the dot-com peak in March of 2000 to what has been happening this month. So, of course, dot-com compared to AI, not apples to apples comparison. You could say completely very different types of technologies and how the expansions and so on. But key is we will share some insights and some concerns, especially on the technical side. The climbs look very similar, vertical kind of climbs. But even with respect to the fundamental factors, let's just talk through some of that. So we're going to jump right into the key part of the theme that the bullish investors are touting, whether it's Tom Lee, whether it's folks who are, mega bullish on the hyperscalers. They're talking about, look at the CapEx spending. That drives the semiconductor revenue expansion, and that drives the explains or justifies the huge parabolic climb that we've seen in semiconductors. If you look at this week, which we just finished, we had 5 out of the Magnificent 7 earnings. And in there, 4 of them, which are really the true hyperscalers spending on CapEx like no tomorrow, talked about over 700 billion of CapEx spending for AI in 2026. You can look at this chart. We can see this 700 plus billion of CapEx spending. We can see the 4 colors with Amazon, the largest spender, with Google number 2, and then Meta and Microsoft are after that. But if you compare to 2024, in a span of 2 years, this is more than triple. So it was about 240 billion or so in 2024. We almost hitting 720 billion in 2025. So it tripled in a span of 2 years. So this has gone exponential. But if you then look at a key chart of Amazon, the biggest spender, they're looking at almost 200 billion of CapEx spending in 2026. Look at their free cash flow. Their free cash flow has turned negative. Their total operating cash flow was about 150 billion. So now they are projecting, and that was just for the completed quarter, 150 billion of total cash flow. Then free cash flow is now turned to -2. Look at what happened back in 2022. Before the 2022 bear market correction happened, late 2021, in fact, they had -2 billion of free cash flow. And then it took almost 7 quarters for them to recover from it to go back to positive free cash flow. That's something we need to be cautious about. Can they be continuing to spend on AI, thinking that, okay, there's a lot of margins coming out of the AI expansion. Customers are hungry for agentic. Customers are hungry for AI compute, and hence they just would invest on that and directly monetize it. If their free cash flow is turning negative, they could run their business. They could run the business with operating income and so on. This is a concern. And if this is the beginning of what happened into 2021 into 2022, this cash flow, free cash flow starts getting deeper negative. And we have that kind of slowdown in the economy where not just that this peaks just from the free cash flow, what if this operating income starts peaking out and starts dropping, just like we saw in the 2021 into 2022, late 21 into 22, operating cash flow came down, and as the operating cash flow came down, their free cash flow turned more deeper into the negative. That's something for us to be concerned about. Also, if you look at a statement or a post in Twitter, very valid post, that if you look at earnings today at these top 4 companies, Meta, Google, Amazon, Microsoft, comparison to .com, they're definitely in a lot better shape, no question. Price over earnings, Meta at 16x price over earnings. Google at 17x, Amazon at 24, Microsoft at 25. Compare that to the .com. Microsoft at that time had 73 times earnings, Cisco had 200 plus times earnings, price over earnings, and Yahoo was 800x. So yeah, no question that price earnings comparisons wouldn't really make sense with respect to calling that this is a bubble. So this gentleman clearly says that this is nowhere a bubble like what we saw in the .com. Agree. But then he brings up an interesting part that that doesn't mean just because there's no bubble argument that there's not a bear case. And his points are very valid. The risks are real and structural. Capex is now over 700 billion with no proven model of how to monetize this at full scale. This is a very valid point. Think about the depreciation on these GPUs. These GPUs in a span of 2 to 3 years depreciate very fast, and next technology comes up. NVIDIA is constantly coming up with the next generation technology. And as those next generation technology comes up, and as the AI compute needs are shooting higher and higher, because there is that feeling that to get more smarter AI, you need more compute. That's an unsustainable part of a compute that's going on right now. What if with slowdown, with actual impact in the economy, with the higher oil prices, with the geopolitical uncertainty, we start getting the operating income of these companies coming down? How are they going to power their CapEx? That CapEx is directly connected to their operating cash flow. Their operating cash flow starts coming down, or operating income starts coming down. Powering at this unsustainable kind of CapEx spending may not pan out. More importantly, what he's talking about is if the crowded nature of these magnificent four. So out of the seven, we talk about Meta, Google, Amazon, and Microsoft. Those are all the hyperscaler kind of growth. If their CapEx spending, if you look at also the percentage to the S&P, significant percent of the S&P's weight comes out of these companies. Look at just market cap. I mean, it's unbelievable. NVIDIA had hit 5 trillion. It's now slightly below 5 trillion. That's the topmost market cap. But Google has just come down from the 2 billion mark, now touching NVIDIA and about to take it over. NVIDIA is at 4.8, Google is at over 4.6. So Google is about to shoot up. It did extremely well in earnings last week. So that's something, that risk of that concentration on the S&P 500 could mean any kind of shakeout or correction in these mega trillion companies would have a negative impact on the broader index S&P. And then the bear case is that though it's not from a PE perspective, multiple compression on durable cash flow could be the bear case, which is exactly what we're talking about. This cash flow, that starts already gone negative for Amazon. Others, if they keep just taking the operating income and throwing it all into GPU buying, it might be unsustainable at some point. And that's what we're going to talk about and think about. So let's look at in the earnings that just happened for the last week in the Magnificent Seven. We've sorted this from the market cap. NVIDIA, the topmost market cap at over 4.8 trillion, it fell 4.72%. So with all the AI euphoria and the GPU spending and all that, NVIDIA got hit last week because then discussions of Google monetizing on their own AI processors called TPUs, and Amazon monetizing on their processors called Trainium hit NVIDIA, that they might, after all, see some competition from the hyperscalers. They may not all just be expanding on NVIDIA's GPUs. These alternative AI processors could have a space, and these hyperscalers are realizing that if they start monetizing on that, that could further assist improving their profit margins. So they are looking into that, and as a result, NVIDIA took a hit last week at down 4.7%. Their earnings doesn't come out till later in May, but because of the negative impact from competition from Google's TPU and then Amazon's Trainium, this took a hit. Google was up 12%, 11.95. Absolutely the biggest beneficiary, and they're growing at a crazy pace. So from 4 point maybe 1 or 2 trillion at the beginning of the week, it hit 4.66 trillion in market cap, or up 12% in just 1 week. So that's the biggest gainer, Google right here. And then Apple, the third market cap, had a good earnings. They are up 3.35% for the week. Microsoft down. So Microsoft was down almost minus 4 6 or 4.5%, recovered a bit on Friday, got a bit of a bid, and at the end, down 2.4% for the week. Amazon was slightly up at 1.6%. Meta down, just the opposite, tale of two companies. Google up 12%, both in advertising, but Google up 12%, monetizing AI better, versus Meta on the opposite end, huge capex spending, but not to the extent Micro had been concerned about their extreme capex spending, and they let 10% of their employees go. Meta was down, almost down 10%, minus 9.8. And then Tesla got a bit of a bid into the latter part of the week. From Wednesday, it was down below 0%. This is in orange, is Tesla. And then on Thursday and Friday, it got a bit of a bid, closing up for the week at 3.86%. So that was the Max 7 earnings reactions and how it responded last week. Let's look at the ETF, the Roundhill ETF MAGS. Look at, in spite of all the extreme euphoria and extreme AI excitement, it has not yet taken out its October peak. MAGX October peak was at 68.14. The highest it hit this week was at 67.47. Negative divergence in RSI. MACD is about to complete a bearish cross, something for us to be cautious about. Negative divergence RSI, MACD histogram about to do a bearish cross. Signal line go below the red line, indicating that we might be kind of topping out for the time being on the Magnificent 7 ETF. So that's something for us to think about. Now let's look at the semiconductors, because that, by far had an astronomic or a huge gain in the month of April. So from that March 30th low, 18 consecutive days of climb in the SOX, the semiconductor index. And that 18-day rate of change is what we have plotted here. Rate of change for 18 days hit 49%. So it was a 49% gain in the semiconductor index in a span of 18 days. Absolutely amazing. So this week, we just finished a couple of days, Monday and Tuesday, it fell, but then back up again, taking a higher high. But as it's taking a higher high above that from last week, look at RSI at a lower high. Look at MACD histogram has begun to start curving lower. So that's a concern. That is semiconductor a bit too long in the tooth, came up too far too fast? Could we be getting ready for a pullback? So comparing this straight into what the semiconductor index did in the dot-com times, look at how, before we do that, we can look at just the monthly. So from the daily, to get a better perspective on this huge gain that we had in April, look at the monthly chart of SOX. And in the span of just 1 month, in the month of April, look at from where it climbed. Look at that candle, white hollow candle, huge climb. And look at MACD, 83 almost, RSI, 83 almost, extremely overbought. MACD is stretched out, extremely overbought as well. So now we're going to compare this to what happened in the dot-com period. This is a daily chart of SOX. And we can see that during that time as well, that vertical climb came from February into early March. Similar kind of vertical climb like we just saw here, right? Right here. So this vertical climb is very similar to the vertical climb we saw back in the dot-com. So that's where the comparisons. Forget the fundamentals, forget about price over earnings, but look at just the chart-wise, look at the technical patterns, very similar kind of vertical climb. Look at the rate of change of 18 days at that time. It didn't hit 49, but came close at 40% plus. And from there, look at the pullback that we got in swing after that parabolic peak. In a span of like from 1347, it came down to 821 in a span of the next couple of months. It came back to where it started from. It started from about the 800. It came right back to that level. From there, made another attempt to climb, but then from there, it fell again. So that's something for us to look into. And if you look at the monthly chart of the SOX index from that dot-com period, this is from 97, 98, and so on. Look at that absolute climb that it had, right? So in the span of 2000 was the peak of March. Look at that February of, so this is January, February, March. Got a reversal candle with a long tail. This, when you get a long tail, that's almost a shooting star kind of a bearish candle. That's how it ended that month in March. And then from there into April, into May, look at how it came right back from where it started to that lower 800 level. Had a bit of a kind of, recovery. and then again fell deeply and fell to significantly lower lows by the end of the fall of that into October. It hit from 1300 down to almost 500. So it got cut in more than half. That's what happened there. Are we preparing for something similar is what we need to look into. We're going to watch this candle in May. So far, it's showing 0.87% gain. Let's see how the candle shapes out by the end of the month. That's what we're going to look back and share with you guys. If we see a similar kind of a bearish reversal candle like we saw in March of 2000, would be similar to May here, that would point us to be cautious about the semiconductor sector. Now, a poster child of the dot-com climb was Intel. And look at what Intel did this is in the span of, 2000. In the span of December to, March peak, look at how Intel started off at $20, doubled to 41. From December in the span of 3 months, from early December into 1999 to, March, it doubled. A similar kind of doubling happened very recently. From where? Well, look at 40. This time it was not like 3 months. It happened in a span of just like 3 or 4 weeks. From 40, it doubled and more than doubled. It hit 100. On Friday, it hit 100, pulled back right to close below it near 99.6. But look at that vertical climb. So if Intel, which, was the dot-com poster child in the semiconductor industry, look at how it had vertically climbed and then, doubled from 20 to 40. The same kind of phenomena happened this time. From 40, it hit 99, close to 100. That's absolutely amazing and something for us to be very cautious about. Now, we're going to show what happened in the Nasdaq index. QQQ wasn't quite there till like from 98 or 99, but Nasdaq is, of course, a lot longer. So if you look at Nasdaq's index from 97 and look at that climb, we're talking about a factor of what? 1300 to 5100. Almost 4x climb in a span of what? Little over a year and a half. So from October 1998, from 1300, it went almost to 5200 by March of 2000. So in a span of a year and a half, it did that. Look at what Nasdaq did more recently, right? Of course, 5,000 went to 25,000. So we went 5 times in a span of 26 years. But look at the climb that we got off the level into 2023 October bottom at 12,550. From 12,550 to 25,000, 2x climb happened in a span of 2.5 years. So this took 2.5 years for it to get there, versus here, 1.5 years, it went 4x. So that's kind of scary. Look at again that vertical climb of the candle in February of 2000. Look at the vertical climb of that candle in February of 2026 that we just saw. Sorry, in April of 2026 we just saw. Same thing here, lower RSI. We'll see how this negative divergence pans out by how this month ends, but something for us to be cautious about. Same thing, MACD is now a weaker climb like the MACD that we saw earlier in 24, 25. We can see MACD histogram is getting weaker and weaker. Something for us to be cautious about, that we might be stretching out to a point where a pullback could be coming in the remaining months. So with that, we'd like to say that while Tom Lee is saying that 18 to 24 months of extreme bullishness is coming in the markets, Paul Tudor Jones, a very well-known Wall Street pundit and a money manager, has cautioned a 30% correction possible in the markets. We'll see who's correct. We feel that, in summary, if you look at the capex spending, over 700 billion, it's getting a bit unsustainable if we start looking at the impact to the negative cash flow that these companies are getting. They might have huge operating cash flows, but what if that comes down? And what if with all the capex spending, their negative free cash flow starts deteriorating, like what happened in 22? Something for us to be cautious about. Looking at MAGS, look at that, hitting almost a double top. 68, it didn't quite get there. Negative divergence in RSI, MACD histogram is about to have a bearish cross for us to be concerned about. SOX overall, the semiconductor index, 50%, 49% climb in 18 days, unsustainable kind of climb. Similar kind of sharp climb happened in the dot-com peak, and from there, look at how it pulled back. Something for us to be cautious about. And from a monthly chart, look at that candle in the span of April to what we saw in February of 2000. Similar kind of vertical climb, and then with that bearish candle that we saw the following month in March is what we've been looking for in the month of May this year. Intel, absolutely amazing climb from 20 doubled to 41, right, in a span of like 3 months. This time it doubled in a span of 4 weeks from end of March till early May. It doubled, right? That's how much Intel did, but more than double, 2.5 times literally from 4,800. Nasdaq, that kind of a vertical climb with a huge overbought kind of a nature. Similar kind of vertical climb with an overbought nature is what we can watch through and be cautious for kind of a pullback, sharper correction later into 2026, into 2027. So that good luck investing. We'll talk to you next week. Thank you for listening.
We are not registered investment advisors and encourage our users to consult with their financial advisors before making investment and trading decisions. Nothing contained in our content constitutes a solicitation, recommendation, endorsement, or offer by us at Chartsarefun or any third-party service provider to buy or sell any securities or other financial instruments in this or in any other jurisdiction in which such solicitation or offer would be unlawful under the securities laws of such jurisdiction.